Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. I'm delighted to have with us Mike McGlone, Andrew Critchlow, and Victor Yang, three of our seasoned speakers and contributors. Great to have you, gentlemen. Victor, let's start with you first. Lots happening in China. We'll get to Putin's visit with President Xi. But I just wanted to start by looking at, more immediately sort of China demand, China economy. We have a result there from one of our questions this week, which was, what's going to determine China's appetite for oil imports in the second half of the year. Let's focus now on the second half because we're already in mid-May. We see that, our survey said international oil prices, meaning, again, addressing the sort of price sensitivity strategy that China seems to have in terms of when it buys oil and when it doesn't. So give us an update mid-second quarter now on China's appetite for oil imports. What have you seen in the last couple of weeks, and what are you forecasting for the second half of the year?
Yes, as we can see, China's crude imports in the first quarter grew 2%, but they were still slightly below the daily average in 2023. And for May, June, and July, the imports could even drop slightly because first, imports in the same month last year were high. Some months above 12 million barrels per day, or about this level. And for this year, we still had peak maintenance in April, May. Basically, April and May. We'll see less maintenance in June. But refineries are not going to hide their crude runs yet. For instance, PetroChina aims to raise its crude throughput by
Mm.
just 5.1%, 5.1 million barrels in 2024. I mean, for the whole year, 5.1 million barrels. But in the first quarter, it already boosted its throughput by close to 27 million barrels. So
How much
to
is
stick
that?
to
Sorry,
its,
just say again, how much?
in the first quarter, close to 27 million barrels already.
Okay.
Already
Okay.
above
Wow.
its annual target for 2024. So to stick to this level, this target, it needs to cut its crude runs year on year in the coming months. And for Sinopec, it already had its throughput by over one third. In the third quarter. I mean, for the whole year compared with the whole year plan. So it's going to slow down its crude run too. And for independents, their run rates are now quite low. For instance, in Shandong, conventional independents run rate are already at 2-year low. And now they are under quite heavy pressure from product sales. So they do not show any intention to raise their crude runs quite
Mm.
significantly yet. Yeah. So we
Okay.
expect the country's crude run, yes, to kind of decline slightly.
Okay, interesting. Thanks for that, Victor. A lot of sort of China preempting and running a lot of crude early on in the year. Andy, let me go to you. Andy Critchlow, head of news EMEA S&P Global Commodity Insights. Let's talk a bit about that sort of again, sort of China demand or demand, global demand, really expectations, which obviously incorporate China. I'm sure you've seen the headline of the recent IEA market reports, which they revised down their demand growth forecasts for this year. Of course, we have others not doing that, and much of that being attributed to Europe and gas oil demand, etc. But again, I mean, I was getting the impression in the last month that things are looking up, although the oil prices stayed steady, and we'll talk about that. That the global demand outlook picture for China as well is looking rosier for the second half than people were expecting.
Yeah, it's very contradictory. I mean, our forecast is actually for a bit of a tighter picture going into Q3. Part of that's driven by the expectation that OPEC will extend its voluntary cuts. But also, I think what's happening in the Chinese economy, we're starting to see that manifest itself in terms of the physical market. Really interesting story that we published a few days ago about the crude slate of the Guangdong Petrochemical refinery. This is one of China's newest refineries, set up really to handle these heavier crudes that we see a lot of now on the market, the heavier sour crudes. And they're now saying that a $7 to $8 discount to ICE Brent for Venezuelan heavy sour crudes, which was previously a big part of the diet of this refinery, it's not enough. And so they're looking for $13 to $15 a barrel now against Brent. And so they're turning now to these new heavier sour grades that are coming into the market, new or streams of medium sour grades coming into Asia. We've seen that with Urals displaced in Europe, flowing into Asia, making that market much tighter. We're going to get more sour crude from this weekend onwards. Of course, the TMX pipeline expansion, first cargo expected to load from the West Coast this weekend. That grade, dilbit, will start to flow into those Asian markets. So the point here is you've got slowing fundamentals in China, and you've got more crude coming into what is already quite a competitive market. This market share battle is going to be a theme into the third and fourth quarter, in my view.
Okay, thanks, Andy. Mike McGlone, senior macro strategist at Bloomberg Intelligence. Welcome. Nice and early, I guess, from the US, or nice and late. Sorry, nice and late, late at night. Mike, good to see you. We've got a couple of headlines in our bulletin today, which saying oil prices rising on slower inflation. This whole CPI read that came out of the US, saying that, for the first time in a few months, it didn't defy expectations, and we got a slight blip downwards. I mean, what is this? Does it really, these are very minuscule changes, aren't they? We're seeing month on month. We're not really seeing that drop to the 2% anyway, are we? So what does that tell us about oil prices, oil demand, and the economy going forward?
Well, I think what Andrew and Victor said is key, is we have to depend on OPEC to cut supply. We have to depend on slowing fundamentals in China to reverse. And we have to depend on the key things that were pressuring oil before the pandemic to reverse, and that is the excess of supply out of U.S. and Canada for prices not to go lower and do a normal cycle. And that's what they're doing. As far as inflation in the U.S., it's on the way down. But inflation in this country is probably not going to drop until the stock market does. I mean, we've got to the point in the stock market so expensive, and it's 2 times GDP. On the way up, the last time that was that high was in 1929. So that's the key driver. Inflation was a little bit tame last month because the stock market was down last month. It's that closely correlated. The key thing from crude oil to remember is at $78, $79 a barrel in WTI, that's basically the median mode of last year. The high was 95, the low was around 67. The risk is it goes towards 67 and follows the example of natural gas. It has to get to the low price cure to shut off those forces of excess supply and slack demand. And the key thing I like to watch is just look at bond yields in China. Maybe Victor can comment on this. 10-year note yields in China right now are 2.3%. That's the lowest ever. Those are severe deflationary forces. We have bond yields in Europe and Japan. They're all much lower than the US. That's part of the strong dollar, weak economic growth. And the key thing that's notable about commodities, the only major commodities that are going up are those that have slack elasticity of demand. That's metals, led by gold. Copper's doing well, industrial metals. Everything else with the normal elastic forces are going down and should continue to go lower. I look at natural gas, I think, is the key example for what we should expect crude oil to do. Natural gas got below its low price cure in this country. Crude oil's cost of production in this country is around $56 a barrel. That's probably where it's going. And the key, I think the key risk is that we just have a little back and fill in beta. You have the U.S. stock market on a tear, up 10% this year. Gold's up almost 15%. So there's a problem there. Gold's outperforming the U.S. stock market. So I look at it as, and with the election coming up, the risk is that we just have a little bit of normalization. But the big picture for commodities is the cycle's still heading lower, most notably for petroleum. It's still heading lower, most notably for grains, and needs something to shift to make it change and move the other way. But as far as U.S. economic growth and inflation and things, it's unfortunate now that beta is one of the most significant driving forces in commodities, and the stock market's way overdue for a little bit of a correction.
Okay, now yeah, for that to happen, they're going to have to increase rates, right? And certainly not cut rates. And yet others argue that the only way to get themselves out of the debt problem that they're in is to start cutting those rates, right? So a real dilemma there for the Fed. We'll go into that a bit more later, Mike. They're kind of stuck. Victor, back to you. Let's talk a bit about something that Mike touched on, that China, bonds, etc. I want to talk to you because China did announce the last week or so issuing a very big bond, trying to sort of raise some cash for this economic stimulus that it needs to do. Where are we with that now in mid-May in terms of planning going forward, the sentiment of how much stimulus the government is willing to do to get this economy going? Does it need to, do you think? Or have things started to feel like they've improved, economically speaking, generally?
Well, the government will start issuing such bonds tomorrow. Yes, Friday. And it will be issuing quite a few batches until November this year for 20 years, 30 years, and 50 years. It aims to, well, to issue bonds for a total of 1 trillion Chinese yuan. And these bonds are aimed to give a boost to large projects, particularly in the construction sector, because now the local governments are facing such a problem, a short finance problem, and they need to get funds to start the project before they can get support from the central government. So these bonds are just aimed to get these projects completed, so it can, well, drive up investment and consumption, employment, and such a sector. And in the end, some diesel demand, some oil demand too.
Okay, thanks, Victor. Andy, just back to you on, let's talk a bit about OPEC. We've mentioned them a couple of times this morning in terms of Mike was mentioning also, the support to the market. I mean, I think it's a foregone, well, it's perhaps not, because I think about a few days ago, people were saying, oh yeah, they're going to definitely stay where they are. They need to keep supporting this market. It hasn't, gone bananas, that they need to start releasing more volumes. But we also got a few comments from analysts in the market that these voluntary cuts, which is really what everyone's watching, could be changed at any time. We're not necessarily looking for a June the 1st sort of date to get that outcome or not. But still, expectations are that OPEC should not get gung-ho about the fact that prices have stabilized nicely. Is that correct? And I mean, do you expect, if you're a betting man, would you say that they won't do anything, at least for the third quarter?
I think that the voluntary agreement is extremely fragile at the moment. I mean, we saw news reports yesterday that, OPEC now, the June meeting is going to be virtual instead of the physical meeting in Vienna. Of course, that to me could signal that there is already dissent. Of course, it's not in OPEC's interest to have lots of reporters in Vienna, lots of people asking questions on the ground. It's an uncontrolled environment in the hotel lobbies. You can get delegates on the sidelines and they tell you what they're really thinking, as opposed to the message that they're being instructed to hand out. So this shift possibly to a virtual meeting, I think, is significant, and it shows the level of discord. We've had also, changes in Iraq, second largest producer, but also Iraq, historically, according to our secondary source survey at S&P Global Commodity Insights, one of the worst offenders in terms of producing over quota. You had changes at SOMO, the state oil marketer of Iraqi oil. Last week, a new director general appointed, a new OPEC governor appointed. Clearly, our sources in Baghdad saying that Iraq cannot produce less than 3.7 million barrels a day. This is excluding the barrels in KRG, which are being sold onto the market via local domestic traders within KRG, and are very difficult to track. And Iraq is not alone. In this market, the incentive is to produce more because we're in a weak price environment, and $80, $83, $90 a barrel does not cut the mustard for an awful lot of producers within the group. Economically, very difficult for Iraq. Economically, very difficult for even Saudi Arabia and the United Arab Emirates at these price levels. These are high spend economies, lots of capital expenditure. I think it's going to be a difficult meeting.
You mentioned the UAE because that is one of the members which has, openly said in the last few months, really, or more, that, of course, it has capacity increase plans that are ongoing, and that it, it was kind of expecting to see that its quota would at least be adjusted after June. Could we see sort of unilateral adjustments there, to members like Iraq, like the UAE? Could we see Saudi taking more brunt as it has been, or does everyone have to come together, if you like, in that sense?
Well, there's already extreme positioning underway to raise individual baselines. The key thing at this meeting is going to be agreeing new baselines going forward, baseline capacity figures. The UAE 2 weeks ago quietly increased their current capacity to 4.85 million barrels a day on the website of ADNOC. Obviously they want to go to 5 and beyond. A lot of investment there. This baseline issue is absolutely critical for setting quotas going forward. So they need to reach agreement on that. But everyone wants to, squeeze in extra barrels now while they still can.
Yeah.
What does it say about the market going forward? I just can't stress enough this market share battle that is starting to develop now in Asia, and it's all been created by these Russian barrels coming into that Asian market. When you've got tighter economies, tighter demand outlook, it makes the competition for market share in those refineries in India and China absolutely fierce. We're going to see more of that in the year ahead.
Okay, Victor, just to go back to you on that, Russian barrels into China. Have you seen much change this year so far? Do you expect that to be consistently the same? And obviously you've got Putin visiting Xi in the last 48 hours, I'm sure. And of course, one of those topics they're discussing is energy and trade, of course. What are the indicators of Russian barrels? Has China changed its appetite for those as that sort of discount has changed a little bit over the year?
Well, Russian barrels are mostly taken by Chinese independents in Shandong, and sometimes by PetroChina and some other SOEs too, but mostly by independents. And for now, they're quite sensitive to the price. The premiums have changed from, say, minus 10 to several dollars against IC Brent to now below, well, just about minus $1 or sometimes zero flat to IC Brent. So this has lost its attractiveness to independence. And in March and most part of April, the margins for refining imported crude, including is a blend of Russian barrels and some other barrels, turned negative for independence. So they cut their run rate. Now the margins have improved as the price dropped to discounts against IC Brent again. But the margins are not attractive. It is just about below $2 per barrel. And so it's still not as attractive as in 2023. In 2023, when the discounts did say sometimes quite a few dollars against IC Brent, and sometimes over $10 discount against IC Brent. And the margins were quite high, sometimes about 800 to 900 Chinese yuan per metric ton. But now it's just about 100 yuan per metric ton. So it has changed quite a lot.
Yeah, not as good a deal as before. We do have a headline today about Russia's oil exports plunging to a 5-month low in April. Again, the tax on their refineries being on their infrastructure sort of being attributed to that. Let's have a look at our survey question before we go to Mike. What's the most likely to enable oil prices to break above the range that we've seen the last few weeks, really 80 to 85? Nothing's been breaking out of that. Central bank rate cuts, is that what it'll take? Pushing demand up, stronger than expected demand in general in H2 from China in particular, and OPEC plus committing making that outward commitment to extend the cuts to year end. People are expecting it, people are not, and he's saying there's going to be problems if they do that. People are asking for more than that. So let's see what our audience says. Mike, we didn't include one other factor on that survey, which is geopolitical risk, because it is gone, hasn't it? I mean, we're talking about it, but like it's gone, the price has gone out, or it's inbuilt in that price, nothing else to come. What's your sort of impression of that in terms of any nervousness by the oil traders there? We have another story saying oil bills, are dissipating because this risk premium is gone, unlike where it was a month ago.
Take another $20 out and you'll take the risk premium out. You just follow the price, examples of corn, examples of natural gas. I think there's still a risk premium in there. It's settled into a range, but the key thing the market's remembering is the lessons of history. Iran-Iraq war, Iraq, Kuwait, all these type of situations with oil producers produce spikes in oil prices and then enduring bear markets. We're heading that way now. But the macro big picture is, has there been a shift in the global excess of supply versus demand? No, obviously we just hearing Russia oil is just reverting towards China with the Xi and Putin meeting, and the macro is very bad for crude oil prices, and that is the President Xi and President Putin solidified an axis of antagonists. And from this country, there's one thing that everybody agrees on is get out of China. And it's just the lessons of the last 100 years of history. If you wanted to expand your economy, you cozy up to U.S. And if you want to have a problem with your economy, you push back on U.S. And that's what's happening. And that's why I fully expect what you're seeing with closing bond yields. Now, you mentioned central banks cutting in that survey, cutting rates. Central banks are starting to cut rates because there's deflationary, recessionary forces kicking in on a global scale. And there's one major significant engine of growth that's still hanging out there, and that's the U.S. And the U.S. is just a matter of time it tilts into a recession. It's all pointing there. I see declining demand for diesel, declining demand for unleaded gas, corrugated boxes. Retail sales in this country are actually negative when you consider ex-CPI. The curve is still inverted, and the Fed's probably not going to ease. It's the last country to really ease until the stock market goes down and tells them to, because inflation's sticky. So the tilt is towards a very bad cycle for the global economy, oil demand, and you're seeing that in bond yields. Bond yields in the top 5 countries in the world, other than the U.S., are the lowest versus the U.S. in about 20 years because it's tilting that way. What stops that? You usually need a long lag through central bank easing, and they're just getting started. So as far as geopolitical risk, I think it's going to do what normally did, which is, I'll end with this. When crude oil futures first started trading in the early 80s, Iran and Iraq, a war was at it. Crude oil spiked to 130, went down to 10 it was in 1996. And then with the Iraq war, it spiked to 40 and was down to 10 by 1998. Crude oil's heading lower. What stops it? I don't know.
Okay, thanks, Mike. And I'll go back to you a little bit. I want to talk a bit about gasoline as well. Andy, just back to you. And again, sort of on the geopolitical angle, if you like, Middle East issues still, I mean, again, we've reached what seems to be, at least from the reporting, another stalemate in the behind the scenes negotiations about the Gaza bombardment, etc. But we don't see any Iranian action, Houthi, etc. That's all dissipated. I get a sense that we're now entering a phase in the Mideast problem, as the Russian-Ukraine one has, into sort of a prolonged stalemate. Everything's just settling into, unfortunately, a little bit of stability, if you like, in that sense. And people are going to get more patient with trying to sort out this problem. Markets aren't panicking in any way. What's your sort of impression there in terms of how oil market participants are viewing this going forward?
Is it the calm before the storm? Is the question? Gaza is not resolved, and it is, from my observations, a long way from being resolved. And the quiet in Iran, in Tehran at the moment over that situation, can only signal that they're making preparations for, as you suggest, a more drawn out, protracted conflict in the region. One thing is for certain, they are not giving up. Neither side is giving up. and efforts to agree ceasefire, any sort of peace deal, have failed at this point.
How does that, do you think, impact, if at all, the sentiment of Gulf economies that are moving ahead with their, their growth, their investments into their own economies, booming, Saudi Arabia and the UAE? Is there any nervousness there, do you think, from a regional sort of geopolitical point of view?
I think it's very difficult when you get off the plane in Dubai at the moment and you see how the Emirate is booming. It's a great barometer for overall business sentiment, I think, in the Gulf. You wouldn't know that I think I visited there 2 weeks ago, just a few days after Iran had launched a pretty unprecedented missile and drone strike on Israel, and you really would not know. As a reporter, I spent years based in the Gulf during various conflicts, and those Gulf states were pretty impervious to it. But I think overall, globally, the geopolitical situation hasn't got better. In terms of Putin's meeting with Xi, there's only two things that will be discussed. China only wants one thing from Russia, which is oil. Russia only wants one thing from China, which is weapons. Why does it want those? Because, again, it's in a protracted conflict in Ukraine, likely to be a major offensive on the Ukrainian front this year. Is Putin going to try and deal a knockout blow to Kiev and finally win the conflict? That's a big question. And again, we haven't really talked about it, but yesterday we had a unprecedented assassination attempt on a European leader, Slovakia's Prime Minister Robert Fico, an apologist, some would say, for Putin, pro-Russian leader in Europe, a populist, shot 7 times. He's critically ill in hospital at the moment. It just shows you how volatile the geopolitical situation is. What does that mean for markets? Hold tight.
Okay, thanks, Andy. Victor, just back to you. Let's get your impression before we close up on the visit from Putin. Andy just said they're there for Russian energy and Chinese weaponry in terms of the exchange of interests, if you like, for Putin's visit. His first visit since he got re-elected, his third visit to China in a year. So it's all very nice and cozy, isn't it, between Xi and Putin? What's your impression in terms of China's real feelings towards the conflict in Ukraine? Is that going to change in any way? And is anything going to challenge China's other strategic interests by its, strong relationship with Putin? I mean, economically, you can address that from the tech trade problem with the US, for example. Is that becoming a challenge?
Well, I think the meeting will just focus mainly on the cooperation between the two countries, either on energy or other sectors. As for other issues such as the Ukraine issue, and China has been pushing for peace talks between these countries, and made this very clear for quite a long time. So it has been trying to strike a deal between these two countries too, but I have not seen any coverage about their meeting yet. I mean, on what they will be discussing yet. I just saw some reports this morning about meeting Putin in Beijing. I mean, the welcoming Putin in Beijing, and it was quite a grand welcoming, and we haven't seen any more reports on their meeting yet.
Yeah, no outcome. Putin brought his whole new cabinet as well. A lot of reshuffling that he did there. Mike, let's go to you to close up for us today. And there's the result. OPEC seems to be the one that's swinging that vote. Not surprisingly, they're holding all the extra capacity at the moment. Mike, just let's talk a bit about gasoline. We're in the heart now, in the midst of the driving season, or at the start of it at least, in the US. But prices are under control. Give us your point of view of how that market's doing, and how important it is to Mr. Biden's re-election prospects.
Yeah, it's all going the right way. There's pressure on prices, and that should continue. The significance is the demand is declining for gasoline, for diesel, for corrugated boxes, for retail sales. And that, so prices I expect will continue to head towards, they're disinflationary right now, head towards deflation. It's a matter of time, partly because the bar was so high. and that's why the Fed is holding off. It's just a matter of time. But all the trends are there. It's just the economic trends that are very disconcerting. Yes, we have strong services, but the key thing is the stock market is stalwart. It's just at some point that should roll over and follow the example of the inverted curve and yields and things. And so to me, the normal cycle is kicking in, and I don't see a lot of potential upside for commodities other than the metals, most notably gold.
And what's it going to be first? I mean, what will trigger that? I mean, you're saying, will it be rates that trigger the stock market turn?
No. So that's one thing I want to clarify.
Sort of
that it's the stock market like it did in the past. The stock market will guide everything, in my view. I don't think rates will go down until the stock market goes down, because the stock market going up is keeping inflation high, consumer spending strong, and rates high. It's the stock market leading everything now. It's just unfortunate. It's like our debt to GDP. The stock market is so high and so expensive in terms of as ratio to GDP. Like I said, you have to go back to on the way up to 1929 for this to be this relatively expensive versus GDP. So it's all that matters right now, unfortunately. And commodities are doing what they normally do on a global basis. They're tilting that way, and that's where my bias is. That's why it's who's the biggest buyer of gold, and that's China. And I think it's just a matter of time that bull market continues and potentially accelerates on the back of a weaker stock market.
Okay, thanks very much for that, Mike. And thank you to Victor and Andy for joining us today, and have a good remainder of the week, everyone. Great to have you.
Much.
Thank you.